Was now the right time to twist? The Fed certainly seemed to think so, but the Bank of England took a more cautious approach. Welcome to Macro Matters. I'm Ramzan Karmali. The US Central Bank on Wednesday made a bumper 50 basis point rate cut. It was the first time the Fed lowered interest rates in over 4 years. Meanwhile, on Thursday, the Bank of England kept rates on hold at 5% after cutting rates last month, its first reduction since March 2020. Well, to help us analyse the different approaches, I'm joined by Hetal Mehta, Head of Economic Research at St James's Place. Hetal, thanks so much for joining us. So why do you believe the Fed opted for the bigger interest rate cut of 50 basis points over 25 in the end?
So I think there's some element of catch-up involved. The ECB and the Bank of England were the first to go in terms of the rate cutting cycle. And despite the Jay Powell being very clear that they're not worried about the economy, we do know that the labour market has cooled, and that has been playing into their narrative. So it was a balancing act, clearly, and the fact that we even saw one dissent, it's very rare to see that in Fed decisions, does show there was clearly a lot of debate. But I think those are the key reasons why we saw the bigger move.
Is there a case, though, that the Fed have reacted to the market's desires here? Because they were definitely pushing for more of a 50 basis point cut over economists like yourself who were looking for more like a 25 basis point cut.
Yeah, so I think markets had been taking the labour market data, seeing this kind of cooling and extrapolating, and the Fed was probably worried that if they didn't deliver the 50 basis points, that would effectively be a tightening of financial conditions and then be counterproductive to what they want to do, which is to put a floor under the cooling. So I think that the market did to some extent force their hand.
And now it looks like the FOMC aren't averse from more cuts this year either. So if they were to continue, what could the impact be, not just on the US economy, but the global economy as a whole?
So I think the vote split that we saw does certainly indicate further cuts, and I get the feeling that it's going to front load the cuts, even though the longer term rate projections are actually nudged up slightly. So there's an element of getting to neutral sooner. If the Fed does go at a faster pace than we're seeing from the European banks, then we would expect the dollar to actually weaken on the back of that relative to the other currencies, and that's a dynamic that I think many central banks will be keeping an eye on, just to make sure that the currency movements aren't too significant, because that clearly will have more impact on inflation going ahead.
Now in the UK, it was a different story. Rates kept on hold. Why? Because on the face of it, it does seem like there's a different picture now emerging between the Fed and the Bank of England.
I think the UK had been, and the Bank of England had been, fairly clear in its communication at the last meeting that they were going to go gradually. Remember, the last meeting was also very finely balanced, 5-4. There clearly hadn't been enough data for the doves to convince the rest of the committee that they should go with back-to-back cuts. The quarterly frequency that they've been indicating is in line with, I think, a recalibration, a normalization of monetary policy, rather than a desire to ease policy aggressively. And you have to remember, for the UK, that the underlying inflation picture is still quite sticky. So we know that we have public sector wage deals which are likely to exert some upward pressure on overall wages and keep services inflation elevated, and that's really underpinning why the Bank of England can't move to the same extent.
Now, Governor Bailey, though, he suggested that cooling inflation pressure meant that the central bank should be able to cut rates gradually. Does that mean more gradually then, I suppose, than other central banks?
I think so. I think for the Bank of England, we've had this headline inflation fall down to 2%, and then it's edged back up. Really, it's the longer term picture, the underlying inflation and services is a big part of that, which is not coming down fast enough to warrant that same kind of pace. I think maybe 0.25% every quarter is about the right pace, in the absence of any other shocks that might make them go faster. I do think the risks are skewed towards the Bank of England having to go faster, given the deceleration we've seen. Although I think the growth we saw in the UK at the beginning of the year was unsustainably strong, and some slowdown is expected, if we see a further weakening, they've got the option to go faster. But it does still depend on the inflation picture continuing to improve.
Hetal Mehta from St James's Place, many thanks for your thoughts. And that's Macro Matters. Don't forget you can watch more videos on Reuters.com.